Thank you, Carl and Courtney. Welcome to the Halftime Report. I am Frank Holland, in for the judge, Scott Wapner. Front and center at this hour, the fate of the record rally as we await Fed Chair Jerome Powell. He is speaking at the bottom of this hour. We're going to bring you his comments live, and our investment committee is right here, ready to go. Join us for the hour. We got Josh Brown, Joe Terranova, and Jim Leventhal. Before we get the conversation started, quick check on the markets. Remember, we hit record highs yesterday for the S&P and the NASDAQ. Bit of a pullback today. The Dow's fractionally higher. The S&P pulling back fractionally. The NASDAQ, the hardest hit, pulling back just about 1/3 of 1%. And it's just simply investors are rotating out, I guess, on emotion. A little bit of animal spirits in the market as it trades a record high. Another thing I want to point out, we see the S&P High Beta ETF also very close to its all-time high, along with the Momentum ETF. So investors are clearly looking. They're looking for some opportunity for gains at a market trading very close to highs.
Yeah, so Joe's right. That's a good encapsulation of the day-to-day. But our message as a wealth management firm to investors over the last 12 years has always been to ignore the day-to-day. There's not always a new story to tell. There's not always a rotation. There's not always some change worthy of chasing. If you pull back the lens and look at the big picture of the bull market we've been in for large cap tech, you recognize that not every moment has been a great moment to be there, but you've had to be there overall. You can't not be in these stocks. NVIDIA and Apple are now 14% of the S&P 500. That is their highest combined weighting ever. People look at that and think it's unprecedented because they haven't seen a chart of GE and AT&T a few decades back. People think that it's some bizarre anomaly that the Mag 7 is 35% of the S&P 500 because they don't understand the history. Every bull market has had concentrated winners at the top. It's almost a hallmark of how you know you're in a bull market when there's leadership. It's not that bizarre. It might be more pronounced than ever in history, but we're always setting new records for this thing or that thing. The point that people need to understand is this is being driven by earnings. The information technology sector has the largest percentage increase in estimated earnings for Q4 of all sectors since June. And that's why these stocks are ripping. The year-over-year expected earnings rate is 20.4% for these stocks. Why wouldn't they be the biggest? Why wouldn't there be concentration? NVIDIA, Apple, and Microsoft, your three biggest names, are also, drum roll, the largest contributors to the increase in expected earnings for the last quarter of the year. And second place is communications. So, look, that's why these stocks are working. It's why they've been working. They're anomalous throughout history, only in the sense that we have never had companies this large be able to sustain double-digit growth rates for this long at massive, almost unprecedented profit margins year after year after year. This starts in 2016. It's 9 years of this. This year will be 10. So that's what's going on with this segment of the market. Now, you want to tell me, yeah, but tomorrow is going to be, you know, a value rotate. Okay, fine. Have fun. Chase the value rotation. You must have these names in your portfolio. Thank God most people listening to me do.
And what if, for the foreseeable future, it's no longer the 493 versus the 7? Because I think that's really what we're saying here. What if it's not the 490 versus the 10? What if it's the whole market? What if you've got fundamental reasons, as Josh, you just laid out for the technology trade, but that also extends to the rest of the market? I mean, we've got GDP that's growing at 3.3%. We've got margins, corporate margins that are very high and going higher. The fears of the tariffs crushing margins, it just isn't showing up. The fear of the tariffs crushing consumption, it just isn't showing up in retail sales. So, you know, if I take a look at a segment of the market, and Josh, I hear you, let's not do this thing where every day, hey, now we're going to talk about small caps, but give me just a moment to talk about small caps, because from a fundamental point of view, what I'm seeing here is the S&P 600 earnings per share growth is projected in the fourth quarter to match that of the S&P 500. And even more going into 2026, the S&P 600 small caps is expected to exceed earnings growth of the S&P 500. My point being here is that there is fundamental reasons, as you were saying, Joe, for the market overall to continue higher. And you don't have to, Josh, your point is excellently made. You don't have to do this game of today I'm going to be in Palantir and tomorrow I'm going to be in ExxonMobil. It is a broad broad market rally. It is continuing. Yes, the S&P 500, the market cap has exceeded the equal weight so far this year, but they're both working right now. Just be in it and enjoy it.
All right, taking a look at Oracle and NVIDIA shares moving lower right now. For more on NVIDIA's OpenAI investment, head over to CNBC Pro with a look at how some investors are worried the news is raising some red flags and it could be a bubble. You see the headline right there. Josh, I'm going to come to you with this one. JP Morgan, in fact, out with a note about this NVIDIA OpenAI announcement, saying in part it's rarely a good thing when a company funds purchases of its goods by direct customers. And some are going so far as to say we're at the end of the build-out phase when companies have to, quote unquote, pay people to buy their stuff. How are you seeing this, and how are you seeing some of the commentary from Sarah Friar we just heard from Mackenzie Sagales?
So it's a great question, Frank. Thank you. And Joe and Jim both have a similar tenure than I do, and we were all around for this thing that went on in 1999 and 2000, which was vendor-financed technology purchases. And in fact, when that became basically the way companies were hitting their numbers or selling their IPOs on Wall Street, it did not end well. So it's a legitimate concern. Basically, we had this thing with telecom and technology, and we had vendor-financed sales of equipment. We had these competitive local exchange carriers, or CLEX or CLEX, we used to call them. There was a new one coming public every week. Basically, each one of these thought they were going to build their own version of AT&T, but with fiber optics. And a lot of the way that servers were being sold and routers and switches into that environment was basically like, here's the money, buy X amount of equipment, we'll do the financing for you, and then like we'll kind of round trip it when your earnings are due, et cetera. It was like it was like the tail end of that particular boom. I don't think that that's a perfect comparison. And the thing about when you need your customers to buy, that doesn't really sound like it's the same thing as what I just described as is taking place right now. These investments are going to be made anyway. These data centers are going to be built out anyway. And whether one player wants to have a bigger investment than another player, it's not we need to do this in order to make our numbers. It's like, no, strategically, we want to be part of this project. In the case of NVIDIA, you're talking about a $4 trillion and change company making a $100 billion investment over multiple years with an obvious ROI attached to an investment like that if it leads to GPU sales and services revenue. It's a little bit different than what we've seen in prior CapEx booms. So I won't say it's totally unfounded concern. I would just say it's not quite as dire as that rhetoric makes it sound.
I want to go to the back end of that headline we just showed, whether or not this is a bubble. There was a Bain report out today saying by 2030, there's going to be $800 billion of a revenue shortfall for these AI companies, based on the investments that they're making right now. Jimmy, you're wincing a little bit.
I'm giving a wry smile.
Is that potentially one of the reasons you think we may see an NVIDIA pulling back today and Oracle pulling back today? This report, again, from Bain, $800 billion revenue shortfall. In all fairness, it's in 2030. I do want to point out it's in 2030.
I want to be careful about the parable of the grasshopper and the ant, but 2030 is a long way away.
Well, it's a long way and a short way away.
No, it's a long way away. I mean, it just is. I think maybe a different way of answering your question or rephrasing your question is, will there come a point in time where the AI trade is a bubble? Almost certainly. Is it now? Almost certainly not. I don't know what inning we're in, third, sixth, but we're not in the ninth inning here. Josh pointed out what was going on in the tech telecom boom of the late 1990s. But as he points out, and as I'm going to repeat slightly differently, there's a question about whether this money being spent is being spent on productive return on investment types of projects, or if we're just laying down dark fiber optics as we were doing in the lower end of Manhattan. I saw it all day long. You dig up the street, lay fiber optics, pave it over, and do it the next day. I mean, literally the next day. And you end up with a lot of unproductive capacity capacity. That's just not where we are in this trade right now. So to the other side of this, I look at the announcement between OpenAI and NVIDIA yesterday, and I say to myself, great. NVIDIA is enjoying exorbitant profit. Yeah, I'll call it that, but I don't mean it in an accusatory fashion. It's enjoying exorbitant profit, and it's recycling it back into the ecosystem, which is the means by which Oracle is going to get paid for what it's doing with OpenAI. It's a virtuous cycle now. Will it at some point become unvirtuous? Yes. If that's 2030, I'm sorry if this makes me the grasshopper. I'm not usually like this, but I'm not going to worry about it in 2025. I am a bit of a disciple of Ed Yardeni. I think he gets it right when he says, where do recessions occur? When does the economy go awry? He points out that it's not because the Fed raises rates. That's not the condition we're in right now, obviously, but it's when the banking sector gets into trouble. It's when the banking sector gets into trouble, perhaps because the Fed raised rates, and they can no longer lend. We are clearly, to your point about the Fin 5, Joe, we are clearly very far from any difficulties in the banking sector. And that would indicate to me that this AI cycle that we're going through and this overall economic cycle has legs.
Wait, you're talking about the overall economic, so we got to dig into that for a second. A lot of this economic cycle has been held up by the AI boom. Jay Powell said it. A lot of notes out today saying it included Deutsche Bank talking about NVIDIA and the AI capex boom. They say in part currently carrying the weight of U.S. economic growth. The bad news is that in order for the tech cycle to continue and contribute to GDP growth, capital investment needs to remain parabolic, and that's highly unlikely. So it doesn't have to be a bubble, but if it slows down, doesn't that slow down the economy? Doesn't that slow down the ability of these companies to make...
That's natural, though.
Well, I agree, but like I said, their estimate it has to be parabolic. I think all of you are saying,
I don't think it has to be
including you,
parabolic.
Joe, there's room between a raging bull market and a bubble, but where in that continuum does this trade slow down significantly and become an issue when investors are really paying up for a lot of these names?
Where's the inflection point, I think, is what you might be searching for. And I don't think anyone, I think the truth, I've been doing this a long time, I don't think anyone can identify the inflection point. You only really see the inflection point after it occurs. And unfortunately, that's just the reality of what we do in this business. I think what's important is how do you react to the appearance of the inflection point. That's where a lot of people get into trouble because they remain skeptical that it could be some inflection point, but I don't think any of us know that. I don't see any compelling evidence in the near term to suggest that's where we're at.
If one wants to make the comment, go ahead, Josh.
I'm sorry, very quickly, like respectfully, could you imagine any of the three of us thinking we know better than Jensen Huang about whether or not there's an inflection point in AI capex? Like, think about the audacity of that idea. It's like, oh no, Jensen Huang is going to make this huge investment, and we're like, you probably shouldn't do that, dude. Here's my let me vomit up some AI knowledge that you might not be familiar with. It's almost like on its face is absurd. The thing that we have to guard against as investors is when everybody gets too bullish all at the same time. You could have a bear market within a bull market. Like, you could get killed in one of these stocks. And so what's the right answer? To Joe's earlier point, this is not a binary business. Sometimes the answer is just position size. It's like, all right, I agree that the AI revolution is A, B, C, D, all these superlatives, but like my own risk level is higher than it's ever been because this stock has 20x'd. So like, let me do something intelligent here with my own risk taking. It's not about let me try to predict the end of the AI capex cycle. What are you, insane?
Hey,
ahead,
Josh,
Jimmy.
let me great points, but you know, to this overall comment of hinge point, are we at an inflection point? Are we in a bubble? You know, think about what a bubble looks like. It looks like price to earnings multiples rocketing higher. I am looking right now at a chart of Cisco's price to earnings multiple back in the 90s, and it went from roughly 28 times to 120 times, and then came back down to 28 times. If you look at the Mag 7, and obviously not all of them, I'm not going to include Tesla in this as an example, but if you look at take NVIDIA as the poster child, 3 years ago it was around 50 times forward earnings, and now it's around 30 times forward earnings. That's not what happens in a bubble. You don't see the multiple contract like that. Now, somebody will say, and probably is saying to the TV screen right now, yeah, but what about the earnings estimates? Maybe they're going to come down. Maybe they're too high. Yeah, maybe they will at some point, but I got news for you. I don't think it's next quarter or the next few quarters. I just don't see that happening with the demand we're seeing from hyperscalers and others, and not even talking about the international expansion of data centers.
All right, a lot of bullishness here on the desk. Meanwhile, NVIDIA share is pulling back just about 2% right now. Coming up next on Halftime, Josh Brown's back with his best stocks in the market. He says this energy name has an A-plus chart. Find out who's at the head of the class coming up. More Halftime's back in just 2 minutes. And we are back on Halftime with Josh Brown's best stocks in the market. Josh, tossing it over to you.
All right. Guys, as you all well know, rooting for the energy sector, being overweight energy in the modern era, it's a little bit like being a Jets fan. Every once in a while, like, they'll win a big game and everyone will look at each other and be like, are the Jets for real? And then the next week, oh, wait, no, they're not. And that's been the story with the sector. I don't like the sector right now, but there are some really interesting moves happening within the sector. And yesterday, we wrote some of them up. So I want to roll through these with you guys very quickly. These are the 5 best stocks in the energy sector. Valero is number 1. I called this an A-plus chart. Let's go ahead and put up a 1 year. This thing is already broken out. So for people who like to anticipate breakouts, this is not the chart for you. For those that are comfortable buying breakouts and are willing to allow for a low volume pullback here in the stock to get long, I would keep it on your screen. This one, the risk management is obvious. I'd use 136 as a pivot point. You can see that is the 200-day. We had a golden cross here in the chart a couple of weeks back. If it breaks below 136, 140, something's changed. We don't want to be long. Marathon is also an A, not quite an A+, but getting there. There are no sellers here, as you can see. All the sellers have been cleared out. The 200-day moving average is flat. It'll be turning up very soon, like a smile. That's your off-ramp. I'd use the 200-day as my risk management. I have Baker Hughes as a B+, BKR. We've talked about this stock before. It was on the best stocks list prior to Liberation Day. Look at that sell-off in April. It scratched and clawed all the way back. This is the best of the oil field service names. This thing's breaking out. RSI in the 60s, not yet overbought. The August lows at $42 is your stop. So that's your risk reward here. I know it's higher than where it was when I wrote it up yesterday. I wasn't on the show yesterday. My apologies. 2 more very quickly, Frank. Phillips 66, also a refiner, PSX. This is a C, but it could become a B. So I don't want people to get discouraged. It's on the best stocks list, not because of any defined uptrend here. It just happens to be hanging high, and it's been hanging in there for so long that by default, it's become one of the better names in the group. Keep it on your screen. I don't love this one. And then there's Chevron. CVX I personally own. I bought it terribly. Right before that huge sell-off this spring, I got long that false breakout. Was totally wrong and had no discipline. I wrote it down and I averaged down. It ended up being the right thing, but that is not what we do with best stocks typically. That said, big dividend, huge buyback. This is not quite a B yet. It's also a C, but it's a chart that could set up. This is the one that I'm hoping, because I'm long, becomes the next big breakout. But as you can see, you got a lot of resistance in the high 160s. If you're conservative, I would almost let that fight happen before pulling the trigger on a long. I don't quite trust it yet from these levels. So those are your best oil energy stocks in the market right now.
Yeah, energy also the best performing sector today. So, Joe, for the audience that can't see, you had your glasses on for Valero. We gave it an A. You got the Baker Hughes with the B. You took the glasses off. So why don't we start there?
Listen, I don't know if this is the process nowadays, but when I was in school, you had parent-teacher night, and you had to go to school with your parent, and the teacher would sit there and review all your subjects in front of you. And I feel like Josh did that with all of my energy positions right now. Baker Hughes is something that we've had in the Joe T since January. It has clearly been one of the leading oil field services companies. Okay. And they've managed the business. Josh is right. They've managed the business incredibly well in what has been a difficult environment for energy. The refiners really have stood out over the last 6 to 8 weeks. And I think the foundation of their outperformance is built upon a low, stable energy price. Oil in the low 60s is good for these 3 names. The problem that I had personally is I basically got over-levered in my position. I bought all 3. I bought Phillips, I bought Marathon, I bought Valero. What I decided to do is sell out of Marathon, which looks like a bad idea right now. And the reason I did that was Josh is right. Valero is broken out. Marathon is broken out. Phillips is yet to break out. and Phillips has the potential to do so. They have some activism there as well with Elliott Management. So I think the refiner, trader, and energy is right now probably where you have the strongest momentum in terms of price and in terms of earnings growth.
So two very important data points. Jim, just your reaction to Fed Chair Jerome Powell saying that the labor market looks like it's moving below break even, obviously signaling that he sees some weakening, maybe significant weakening.
Yeah, well, and I think the question here is whether the Fed is going to be proactive or not. And let's face it, generally speaking, history says they are not proactive. They wait too late to make moves. There are many things you can look in the labor market and say the labor market's just fine, initial weekly jobless claims. On the other hand, the direction, Joe, to your point about the direction of the unemployment rate is clearly higher, and continuing claims are high. It shows clearly that companies, while they're not firing, are not hiring either. So will the Fed be prophylactic in taking one or two more rate cuts this year? It's probably the right move, but I think it's an open question. I don't think it's decided yet. I think that's what Chairman Powell is going to say. He's going to wait on the data. It is unlike the Fed to do things in advance of bad news. Hopefully they'll get it right this time.
Josh, coming over to you. The Fed chair is saying that tariff-related price increases look like they're going to be spread over several quarters. The estimate for core PCE coming up just this week, 2.9%. Now, a month ago, the Fed chair seemed to think that was okay. Do you think that's still okay for Fed? Well, Josh, I'm sorry to cut you off. We actually want to go to Fed Chair Jerome Powell, speaking live in Rhode Island right now.
Thank you for your warm reception, and thank you, Senator Reid, for your very kind introduction. It is a pleasure to be back in Rhode Island. The last time I had the opportunity to speak to the Greater Providence Chamber of Commerce, as Lori mentioned, was in the fall of 2019, actually November 25th, 2019. And I said then, quoting, "If the outlook changes materially, policy will change as well." Well, little did any of us know, just a couple of months later, the COVID-19 pandemic arrived. Both the economy and our policy evolved dramatically in ways that no one could have predicted. Along with actions by Congress, the administration, and the private sector, the Fed's aggressive response helped stave off historically severe downside risks to the economy.
And welcome to Closing Bell. I'm Carl Quintanilla in for Scott Wapner. This make or break hour begins with this retreat from some record highs. Stocks are pulling back from all-time records as tech does take a breather today. Your scorecard with 60 minutes to go in the trading session. Got the NASDAQ down a full percent. S&P's not that far behind. Got the VIX back above 17. Energy, the best performing sector today. Financials, tech, and consumer discretionary are in the red. We did hear from the Fed chair today. Earlier this afternoon, he described interest rates as modestly restrictive, said stocks appear, quote, fairly highly valued, which does take us to our talk of the tape. Does this record rally have more room to run or not? Let's ask Truist Wealth CIO Keith Lerner and Empower Chief Investment Strategist Martin Norton, who joins us here at Post 9. Good to see both of you. Thanks for coming in.
Yes, my pleasure.
What do you make of, I guess, tech lagging, a little more volatility? This comment from the Fed chair, you don't get that every day about valuations and equities.
Right. And, I think it really is a sign of how extreme valuations are. We all know that valuations aren't a timing indicator. Markets can grind on for quite some time. But what we do see in the data is when valuations get to extremes, whether that is extremely cheap or extremely expensive, that's when they become more predictive of prospective three-year returns. And so I think that's something we're all circling around.
Your general take vis-a-vis the Fed is that the market tends to always get its hopes up on the pace of rate cuts, and this one might not be as dovish as some in the market think. Is that right?
Well, it certainly has been the case over the past several years that the market has tried to anticipate, tried to push cuts, and the Fed has held back. And I think we're seeing a little bit of that dichotomy today. We're seeing the market price in rates that would effectively take rates below 3% by roughly this time next year, whereas the Fed is being a little bit more, or less dovish in that regard.
Right. Keith?
Hello, welcome to Blue Cloud Trading. I'm George. It's Tuesday, September 23rd. Market is closed, and we're going to take a look at the markets and see what happened today. We're also going to take a look at some of the stocks that were talked about on the show. There were a number of stocks talked about, and we'll look at the index ETFs. We'll look at about 8 listed here, like Micron is in there, LRCX, Broadcom. You can see some of the stocks there. We're going to also talk about Apple, Tesla, Meta, and some of our members' requests. But before we get started on all of that, and we're going to look at the technicals, folks, we're going to use the Ichimoku indicator, Japanese indicator. But before we get started on that, let's take a look at what happened today. I mean, you can see that the market moved up. The Dow moved up in the morning, and then around 10 a.m. it just started dropping and continued to drop. It was down 0.19%. So the Dow Jones was down the least amount. NASDAQ was down the most, 0.95%. You see a big little drop there around 1 p.m. You know, the Fed came out and spoke, and that did not help. It was down 0.95. The S&P 500 down 0.55. Russell 2000 down 0.23%. If we look at the heat map here, it's going to show us the individual stocks within the S&P 500. You can see NVIDIA down 2.82, Amazon down 3%, Tesla down 1.93, Oracle down 4.36. The energy stocks did really well. They excelled today. So did the utility stocks and industrials. So there's a little bit of a shift in the sectors for today. But if we look at the 1 week performance, this is the 1 day performance. Let's look at the 1 week performance here for a moment. All right. It's a different picture. So here you can see that NVIDIA's still up, Apple's up still. But some of the companies like Amazon down 5.7, Broadcom down 5.8.5, Meta's down 3%. All right. Now, the other thing I wanted to look at is the groups. Now, the groups are the sectors, and here's the 1 day performance. You can see energy up the most, right? 1.51% today, utilities next, and then real estate. And then consumer cyclical, technology, communication services were down. And there's that 1 week performance with technology and utilities at the top, consumer cyclical, consumer defensive at the bottom. A couple of other things I want to bring up. So Powell, all right, as you know, it says slowing labor market prompted the rate cut. He sees challenging the situation ahead. Powell says the weakness in the labor market is outweighing concerns about stubborn inflation, leading to a decision to lower the critical bank's key interest rate last week. Guys, check this out. The U.S. national debt is $37,511,743 million. It's insane and rapidly growing. Let's take a look at the chart on this for a moment. This is from Fox Business News. U.S. national debt. Look at this from 1995. It's just like, you know, this is outperforming the S&P 500, isn't it? Don't you wish the S&P 500 just went straight up just like that? The unrelenting increase is what prompted Fitch Ratings to issue a surprise downgrade of the nation's long-term credit score. Whoops. Did I just hit a button by accident? I think I did. Hold on, folks. There we go. The nation's long-term credit score in mid-2023. The agency cut the U.S. debt by one notch. You know, we know about this. This happened back in May. And then if we continue to go down here, growing the U.S. national debt. Look at this right here. Insane levels. All right. Now, rising interest expenses from servicing the more than $36 trillion national debt follows a burst of spending by former President Joe Biden and Democratic lawmakers, hitting a 40-year high in 2022. And then September 2022, you said Biden had already approved roughly $4.8 trillion in borrowing, including $1.85 trillion for a COVID relief measure. And then if we go further down, you can see the annual deficit from 1960 to 2023, tracking the U.S. national deficit over time. That big spike there. And then during Trump's first term, the national debt grew by about $7.5 trillion, in part due to the onset of COVID-19 pandemic. Some big numbers there. And the budget deficit for fiscal year 2020 came in at a whopping $3.1 trillion due to those measures. Now, let's see what else. So I actually asked Grok about the new Big Beautiful Bill. I said, how much is the national debt expected to rise due to the Big Beautiful Bill? Here's the answer I got. Projected debt increase, the CBO's primary estimate, including macroeconomic effects and interest costs. This is according to Grok. Projects the bill will add $3 trillion to the national debt over the 2025 to 2034 period. So that's what we can expect. It's just gonna more and more deficits, and this is not good. This is not good. And yet, even though all that's going on, look at this market still moving up. There's no correlation, like I said before, between the stock market and how the economy is actually performing. The S&P 500 still in a very steady uptrend, as you can see right there. This is the daily chart. We've got price above the key moving averages, like the Tenkan-sen, which is the 9 period right there. The Kijun-sen, this is the 26. It takes the highs and lows of the last 26 periods, divides that by 2, and projects it on the chart. That's why sometimes it will be flat, like you can see right here. Same thing with the 9 period. And then you've got the cloud itself, which is taking the midpoint of the 2 moving averages and then projects that into the future, 26 periods into the future. That's the Senkou span A right there. The Senkou span B is the other part of the cloud, which is basically taking the highs and lows of the last 52 days, in this case, dividing that by 2, and it's projected, instead of right under the candle, basically 26 periods into the future. So that's the Senkou span B right there. We want the Senkou span A to be above the Senkou span B, the Tenkan-sen, the green line, above the red line, and we want that Chikou span, which is the closing price today, projected 26 periods into the past, above the candle 26 periods ago. That's basically, those are the rules for a very strong uptrend according to the Ichimoku indicator. And so we've got that with the S&P 500, not just on the daily chart, but also on the weekly chart. Here's the weekly chart for you. All right. And the same thing applies to all these indices. So here's the QQQ ETF, still holding up above the Tenkan-sen and Kijun-sen and the cloud. Here's the Dow Jones, even though it was down 0.17%, still holding up above the moving averages. So it's like a little pullback here. Russell 2000 also holding up. Was unable to, again, close above that 244.98 level that I brought up. You know, it's a monthly level, right? We talked about that yesterday. So you might want to go back to yesterday's video. Talked about this high from 2021. That's the level that we need to take out, 244.98 for the Russell ETF IWM. Once we got that breakout on the monthly and the weekly and the daily, we're going to be, I think, we'll probably see a continuation of the upside, even with all this negative stuff going on. Here's FEZ. This is the Eurostoxx 50 ETF. This one got above. It actually gapped up above the 61.50 level of resistance. Okay, but then closed back under by the end of the day. So you can see that if we switch it to a 5-minute chart, there's the gap up right there on the 23rd, right? So here's the gap up from yesterday. The green line, the dotted green line represents the opening price. The dotted red line there represents yesterday's closing price. So it gapped up, came back down. It's under the cloud right now in the 5-minute. But yeah, so that's interesting what's going on with the FEZ. The VIX continue to move up a little bit more today, up 3.35%, but still at relatively healthy levels under the Kijun-sen, under the cloud. That's the market volatility index. Okay, next, let's go to the next stocks. These are the stocks they talked about on the halftime report. Here we have Micron. By the way, you know, they didn't have a full episode today because, you know, the Fed chairman came out and started speaking. That's why they didn't do the typical last part of the show where they go over their, you know, final trades. So anyway, here's Micron MU, all-time highs. As you can see, basically it's been reaching these levels and it looks very bullish. What I've done here, folks, is I've highlighted out of those 8 stocks, there are just 4 that look really bullish actually on both the weekly and daily time frame in regards to the Ichimoku indicator. It's these stocks, okay? Top stocks right there. So let's look at MU on the weekly chart. There it is. You can see it took out that high right there back on June 21st. That happened last week on Friday, and it's continuing to move up now. This candle is still relatively small. Volume is starting to decrease, so there's not as much momentum here as we would expect, but it's still moving up. Now the ADX, which represents momentum, looks good here on the weekly still, but the positive DI is declining. And here's a daily chart. As you can see, it's just that ADX is starting to just kind of like go slightly sideways here. All right, LRCX, which is Lam Research Corporation. This one also looks pretty good. You can see that once it broke, it came down into the cloud, came right back above. Since breaking above right there from that level, it's already moved up 30.66% in a very short period of time. We're talking about 19 days, 19 trading days. Okay, MPC, Marathon Petroleum Corporation. This one looks great too. This one, you can see that it actually almost looks like a cup and handle type pattern. So you can see right there. There's the, let Let me show you guys something here. Here's the cup, the handle, okay? And basically, once it got above the highs of those little candles right there, you can see it continuing to move up. So, yeah, I mean, it looks pretty good. It looks pretty good. I like it. It also took out the high back here from that level, which is, what is that? 183.10. All right. Here's the weekly chart. Looking very bullish, still above the 200-day, rising 200. You got the single span A above single span B. So I like this one. Here's another one. BKR, also looking good. The only thing about Baker Hughes Company is the fact that it has, and it's been moving for the last, as you can see here, 6 weeks in a row, moving up. The problem here is that it's coming right back to this prior high, that shooting star of 49, what is that, 49.46 or 49.40, sort of, sorry. And we're at 48.93. We're just under it. So, and you can see a little bit of selling here happening towards the end of the day, that little wick that was created. Let me show you the 5-minute. So we basically, here we are on the 23rd, we moved up, and then basically at this level, what time was that around? That was probably around 1 o'clock or so. Yeah, when the Fed came out. It dropped 2.17%. What about Broadcom? Here's Broadcom on the daily chart. It's in between the two moving averages. Now, this one doesn't have a blue flag for that reason alone. It has pulled back, but it could certainly give us a new buy signal soon. Here's the weekly chart. It still looks good on the weekly. KBE looks great on the weekly chart, but on the daily, it is also in between the two moving averages. See how the price is stuck under the 9 period? PSX, okay, this one on the daily chart looks good. Price got above the Tenkan-sen. Let's look at the weekly though. So you can see that it's stuck inside the Ichimoku cloud. One of the rules of Ichimoku is that you do not want to be adding positions when price is inside the cloud. Now, I personally use both time frames, right? So I'm looking at the weekly, I'm looking at the daily to make my decision. I want to see confluence. I want to see synergy. I want to see them both telling me the same story. And when I don't see that, like in this case, then I basically hold off. If there are other stocks that look stronger, why would I want to take the stock that is looking kind of, it's kind of stuck. You can see that right there, that consolidation right there. And it's inside the cloud. Then we've got CVX, Chevron Corporation. Now on this one on the weekly looks all right. I don't like the fact that we created this low here, which is lower than this one. All right. And we have not taken out this high. So we've got a lower high here and a lower low. That's not necessarily a good thing. And that's the weekly chart. Here's the daily chart. You can see we're stuck in this symmetrical triangle right now, and price is inside, in between the two moving averages. So this one too, I would hold off on. All right, and then let's go to the next segment here. These are some of the Mag 7 stocks like Apple. So Apple was down 0.64% today. You can see that it's stalling in a prior high of around 260.10. It's at 254.43. And there's a little reversal candle. That's called a spinning top. And that looks a little bit like this, where the wick on the top and the wick on the bottom are the same level. And it's a very small little body there. If you see this type of candle at the top of a move, that's very bearish. If you see it, the same candle at the bottom of a move, that's bullish. So because this has already moved up, it's kind of a bearish sign. It doesn't necessarily mean that that's the end of this move up. It's just telling us that, hey, watch out. There's a potential for pullback here. That's all. And we are about 5% away from the next support levels here of Tenkan-sen and Kijun-sen, and just about 1.6% away from the support level of 250. All right. Next, Tesla. Oh yeah, did I show you guys the weekly on that one? Let's check out the weekly. So the weekly looks, like I said, it looks pretty bullish. You got the single span A crossing above single span B, but again, on the daily chart, the volume is also starting to come out. See that volume, the volume bars? That's why I'd be a little bit more concerned. Never usually a good idea to buy on a negative candle, generally speaking. Here's Tesla. Now yesterday I talked about this shooting star candle. I said it looks a little bit extended up at these levels here. and we're kind of far away from the Tenkan now. We're approximately, just so you can get an idea, we're about 7% away from the next level of support. And today we had a bearish engulfing pattern. So that kind of looks a little bit like this. It's a double candle pattern. It's under the bearish segment here. There's the bearish harami. So when you've got yourself a large candle like this one here, and then you've got a little baby red candle following it, what that tells us is that, okay, so it went from this prior day's closing price, it dropped, and then continued dropping, and then closed within the body. And that's exactly what's happened here. I'm sorry, I was looking at the wrong candle pattern. I meant to say bearish engulfing, folks. This is what we're looking at. So price basically gapped up and then dropped, closing under the prior candle's opening price. So it's like basically engulfing the prior smaller candle. That's what we have, the bearish engulfing right here. So price gaps up, drops, closes under the opening price right there. So that's not ideal. What about Meta? And by the way, with Tesla, the other thing with Tesla, if you look at the weekly chart, we don't have all of the elements of Ichimoku giving us a good signal here, because we've got Senkou Span A, even though it's moved up, notice what's happening now. It's kind of slowing down, and it has not crossed the purple line yet. The Senkou Span A has not crossed above the Senkou Span B. And it looks like even on the weekly chart, you can see that's a very negative candle that's forming so far. I mean, it's only Tuesday. We won't know what this candle looks like until Friday, but I'm just saying it's not looking good yet. Here's Meta. It's stuck inside of what's called the consolidation zone right here. Just moving sideways. It's still under that 79625 level. I'd like to see it get above that level. And here's the daily chart for you. It's, as you can see, it's inside the cloud. So no on Meta. All right. And then we've got a few stocks from our members. ASTS is AST Space Mobile Inc. Now, this one, it has pierced and broken through the cloud. There's a lot of positive things I'm seeing here. I'm seeing the volume increasing down below. That means that there's more participation. I see the positive DI from the directional movement index. I've got it at a setting of 9. I see that moving up. That's good. Negative DI is moving down. That's good. And the ADX is moving up. The ADX represents momentum. So that's good. You can see it right here. And the fact that it broke the cloud, that's bullish. The only problem is, again, the cloud itself it's not giving us a buy signal quite yet. Senkou Span A is still under Senkou Span B on the daily chart. And if you look at the weekly chart, it does look a lot more bullish, right? So, because you've got all the elements here correct. Now, what about HIMS, HIMS, and HERS Health Inc.? Now, consumer defensive sector hasn't really been a great sector to be investing in. You know, as I mentioned earlier, with the sectors, you can see that it's been kind of like in this almost like a symmetrical triangle type pattern that's kind of building up. And so when you've got something like that, where you've got a series of lower highs, like this high here is lower than the prior one, you can see that decline. It's not something I'd be interested in here. It is above on the weekly chart, the Tenkan right now. And so the Ichimoku does give us, it's saying it's okay, but you can see the cloud also is flat. Let's look at the daily chart. Now on the daily chart, again, Senkou Span A is under Senkou Span B, so we don't have all of the elements correct here. Now, you can see the price did find some support at that rising 200-day, right here, and back over here. And so this might turn into something, but right now, as you can see, it's kind of like hovering right at the top of the cloud, and it was down 2.95% today. What about TEM? That's Tempest AI Inc., Internet Content and Information. This one on the daily chart has pulled back for a couple of days now. It's down 2.03%. It's just in between the Tenkan and Kijinsen. Keep in mind that the profit margins on, basically all three, just the ASTS, the profit margins are negative 7,213.88%. Price of sales, look at the price of sales, 2,311, that's pretty high. HIMS does have positive profit margins, but TEM also has negative 20.98% profit margins. So it depends on whether or not you're looking for a stock. Personally, I like to find stocks that are profitable. I tend to buy stocks that, are in the green when it comes to profit margins, or at a minimum, their profit margins are increasing. And one way you can find out if the profit margins have been increasing quarter over quarter is by just, you can use something like FinViz. So let me go to FinViz for a moment. Let's take a look at that stock for TEM. All right, and we'll type it in here, TEM. And let's minimize this a little bit. There we go. And so, Tempest AI. So let's look at the earnings results here. You can see they were positive, right? This last one on August 8th was positive. This one here from May 6th was positive. The one prior to that was not. Okay, let's check out some more information about this company. So let's take a look at some of this. Now, year to date, it is up 149.2%, but it's down 3.34% this week. If we look at the sales have been increasing. Let's go down to the statements for a moment. Okay. And let's see what we find as far as the net margins. And so there's the net margins. This last quarter, it went from negative 27 back on March 31st, 2025 to negative 14. So that's an improvement on the net margin. And the gross margins also increased. Let's look at the price to free cash flow as well. One of the other things I like to look at. Free cash flow has also increased. So that's good. You can see that from the histogram over here. This is the last reported one that we've got in here. So there's some potential with Tempest AI Inc. But again, I think there are other opportunities that look a little stronger out there. Guys, thanks for watching. And by the way, if you haven't checked out the channel, Blue Cloud Trading, did you know that I also do member-only videos every weekend? And this is what they look like. This is what I do one every weekend, and I did one just recently right there. You can see that there. And all you need to do essentially, okay, is click on the join button. All right. If you haven't subscribed, that's free, but click on the join button. And basically you can choose any of these three levels. Blue Cloud Supporter, where you can request a stock to be analyzed in the show. Blue Cloud Trader. Okay, this is where you'll get access to those exclusive member-only videos. And then if you want even more stuff, like under Blue Cloud Legend level membership, you'll get access to those member-only videos. You can request 3 stocks or ETFs be analyzed. There's some day trading videos that I've recorded there that you can check out. And there are also, the most important thing I think is the daily trade updates, because I share all the trades that I place. So every trading day. And I usually update that, pretty much before the market closes every day, so that you guys can check those out. That's going to do it for this video. Thanks for watching. Thank you for supporting the channel. We are getting closer and closer to, we just went over 23,000 subscribers. So thank you very much. Guys, have a good rest of the evening. I will catch you all in the next video.